Reserve funds and surplus cash, not for profit with Section 8. Project has scheduled project improvements in January, February. Concerned they will have no surplus cash that will be required to be deposited in the R4R. Old regulatory will get no residual receipts. May not be able to timely get a reserve draw to pay for planned improvements. Can they fund a separate reserve account to avoid surplus cash deposit? Is there a HUD account funded reserves? No, it also asks management about paying deposits for the improvements before year end.
A gray area.
It's a gray area. Now, it's gray enough for me that I'm probably going to buy off on you including something in there. It's a dicey thing. I'm not going to lie. It's on the edge. And I'm probably going to go in your favor, but I have to warn you, it may not stand. May not fly. Okay? This is just one of those.
HUD doesn't like it.
Yeah.
Because they want to see the surplus cash and the deposit to the residual receipts.
Now, in this particular case, I would try to do something more concrete to get something in place to schedule that. If I had something in line with a contract or a PO issued for someone to do the work, I'm much more in favor of writing it out that way. It's all in the description of what you put in the other. Okay? Funding separate reserves. There is a couple of HUD trainers out here who tell CPAs that's the great way to get around this. Peter, how do you feel about that?
No, I'm not a fan of that.
I can tell you HUD is not a fan. It's going to be a bad juju thing, so you will not be walking through the tulips too happily there, because people are going to want to make sure they heard that. Okay. We have a client going through the 202 budget process. I've received a comment that their audit fees were higher than, we always have this comment. Is there a requirement? No.
No.
Not only no. Heaven times 9 times no. No. No means no. Unless it's a gnome no. Gnome means no. Look, field offices do some stuff, especially if you're out of Birmingham. I've had that down here. We have also had a client receive a comment from HUD on receiving bids for insurance that were a related party through a board member. Okay, that one is more legit. Now, I had somebody ask me the question here a minute ago about related party services, frontline services being provided through an IOI company. Okay? And this is what I told her. It's the same question here. Can you prove to me that the rates they're charging are comparable to independent third-party rates? If the service is to a related party for the insurance, I'm not going to have too much of a fear over this. It does smack of inappropriate UG procurement guidelines. That's really the question here, because it is a 202. A little too friendly. If I'm that board member, I'm on a PHA board, I'd be running it from this stuff. I would not open myself up to that kind of scrutiny if I'm on this board. You got to be just trying to bend rules. It may be legit, but the optics are terrible, okay? And you're just asking for problems. I can't give them a finding on it probably, but I can tell them if HUD comes out and starts looking at this, they're not going to be as happy as you may want them to be. Any other comment, Peter?
No, that's good. Get some documentation together that shows
Boy,
that.
tell the client to document that
right.
baby back and fill that.
Comparable rates.
Okay, grant income, 15-year restriction period. When we report the grant income, what chart of account should we use? Should we record it to? Well, Peter, that may be back to the old chart of accounts master himself here, you.
That wasn't me.
Well, I'm just saying you were the REAC guy.
That's right.
Other income.
Yeah. That sounds good.
It's going to go down into the other part. That's where it's going to go. It's not part of the, I can't remember the account number. It's 59 something, right? Probably 5990 for me. Give it a description. That's where it goes. I think that even mentions it in the chart of accounts. Okay? Now, there are other grants, depending on what they were, that have specific line items for those. But if it doesn't fit into that, I think the chart of accounts says other things go down into the 5,900 accounts. We have a client that paid off their I've had this question, and completed their restriction period for a 220 grant, but still received Section 8 payments. Their Section 8 contract states they are still required to follow the original regulatory agreement. They hold cash in excess of FDIC limits. Should they be marking no on the owner certified submission for the "Are you in compliance?" question, or can they evaluate significance of noncompliance? So I take it now you're in excess of FDIC limits. That in and of itself is not a compliance violation. What are you supposed to do to stay out of compliance risk? Assess the bank rating. That's all the client has to do. Periodically assess the bank rating. If they do that, they can hold funds in excess all they want. Okay? I think that's right out of the handbook, 4370.2, Chapter 2. Well, then the finding is you didn't do that. So what they are putting themselves at risk for if the bank ever, look, into that, we never imagined that would happen, but in 07, 08, 09, we had people who fell into trouble at certain banks who were above the guarantee limit, okay, before it went to 250. And we were really unhappy about that, and they ate it. Owners eat it. So it's just a risk to them that if they don't, is it a finding? It's clearly a management letter comment to me. I'm not sure I'm going to findingville, but I think that's a kind of a grayer judgment call. But that's what the finding really is. They didn't do the procedure to guarantee, to get the bank rating reviewed. And the truth on this is simple. The banks cannot release their rating to you. Whatever the audit guide says about this is so old, it's against the law for a bank to tell you their bank rating. They can't tell you. If it got bad, we'd all run to get our money. So I go to bankrate.com, look them up. Somebody gave them some grade that I don't know, it might be fictitious, but they have no choices anyway. That's what we tell them to do. So I sit down and say, look, if you didn't do it, go to the computer right now, type in bankrate.com into Google, type your bank name in and see what it says, copy and paste it into a piece of paper and say, there's your documentation. Whoops, that was easy, right? Okay. It's hard to look at significance of noncompliance because we don't really know. All we're saying is you have a risk that you could pay for the money, owner, and that's what it is. Property taxes are paid in arrears. The mortgage companies escrow the taxes. However, it was 12/31. They're able only 8/12 or 9/12 of the amount due in April. Is the 4/12 or the 3/12 not escrowed required to be on the surplus cash calculation as a liability? No, I don't think so. If it wasn't required to be paid. See, the difference is deficits that were required to be paid. If you said no, don't you agree with me there? I paid what I was required to pay.
Sure.
End of that conversation, right? That's right. Mm-hmm. I'm not required to have that escrowed right now, do I? Am I? Okay. The 4/12 will collect them. Yeah. So I think we've answered that question. Who always have numerous freaking journal entries. Man, they just were pretty upfront with this, huh? Don't ever say that word, incompetence. Man, I just screwed my own SKE determinations up, didn't I? Yeah, you're better. Yeah, he said it's better off to say incontinence. No, let's not go to that level today, sir. Okay, how do I avoid independence issues? By not saying incompetence. Look, now I hope I'm not being recorded right now. Look, let's just talk turkey about this. How much does a client know or not know about the financial statements? Now, let me just be blunt. How many of you have ever picked up your local paper that said XYZ housing project failed because CPA prepared wrong financial statements? Never. So why are we flogging ourselves for doing the job we were hired to do? Well, I don't know. somebody decided to get a hold of reefer madness and go in another direction about real independence. I get it, but look, if I'm doing Amazon, I hope they can prepare their own financial statements. But XYZ HUD project, these things aren't complicated. They're consistent. I'm trying to get around any kind of way I can say that the client isn't incompetent. They're just lazy enough, I won't even say that, they're just so busy that it's easier for them to get me to do it. And I don't care how many journal entries there are, unless it's clearly they can't keep track of anything. But the Yellow Book said even reconciliations are non-audit services. I'm going to buy into that somehow and make that work for me. I don't say incompetent. Can I be involved with those AJEs correctly? The Yellow Book says you can do all you want as long as the client takes responsibility and has the ability to do so. Look, the truth is they may be incompetent, but they're going to know the financial statements are materially correct or not. They had 12 months of rent. We paid the mortgage 12 times. The expenses were generally covered. I mean, it's materially correct. Okay? Now, meet with client personnel and discuss adjustments. If you go back to my safeguards on that spreadsheet that the AICPA put together, you could even discuss the number of journal entries and how they affect you with independence and have that conversation in a memo. That is also a safeguard.
We actually put a copy of the journal entries with the rep letter.
Yes, ma'am.
Say
We want to get you on the recording.
we actually put a copy of the AJs with the rep letter and make some kind of statement that we have agreed with all your proposed adjusting entries.
That's right. Look, you're never going to get perfection out of this. But guess what? It just isn't that important. What do I want to do? Get my work done, not get into trouble, get paid. And stay out of, trouble. Audit adjustments recommend. Oh, that was the same one. I thought I changed this paper. How does your client access impairment and a tax credit property past the 10-year mark? Oh, by the way, somebody asked me this earlier about going concern. Okay, let's be honest about going concern in multifamily. The first thing is don't buy into it. And they went to a training, and the trainer said, oh, negative equity is always going to be a sign of a blah, blah, blah going concern problem. You better have documentation. Not true in multifamily. We have negative equity all the time. The minute they go back to get that $1 million of refi money out, 80% loan to value, we're going to go negative equity because we can't write up the building to a fair value. They took out the fair value and they decreased equity. And so what I'm going to do in the quality control document for housing, I'm going to say, look, straight up, negative equity itself is not a sole indicator of going concern problems in multifamily for the following reasons. Then you're going to marry it with negative equity and I'm not even equity, you really care, cash flow, right?
Should you be doing that or should the client be doing that?
No, I'm going to indicate that for my purposes, I'm not considering that as an audit risk just simply because of negative equity.
That's actually a new requirement, is getting going concern evidence.
That's right. Now, I'm just saying I don't need to go get going concern evidence because the indicators for me weren't there. But if the client had problems, now my cash flow.
You have to get it whether there's indicators or not now.
Well,
I hate the rule, but
there's some conversation that we don't need to get into that. But look, it's cash flow that's doing a multifamily project, not equity, right? Are they renting the units? Are they cash flowing the project? So for me, how do you assess impairment in a tax credit property past the 10-year mark? This is the problem with all this. Where's it going to go? Who's taking the project? I'm out of compliance period. How does the project go? I'm assuming it's not a Section 8. It's just tax credit. If it doesn't cash flow, I can tell you right now that ain't my problem. That's the client's problem, isn't it? What are you going to show me that you're not going concern? We all know the challenge. Is rent going to continue? Is cash flow going to continue? Only thing I really want to say is negative equity alone may not be my trigger point for anybody. I would tell the client negative equity is not the trigger for multifamily. I just write that down somewhere and say, look, I get it from everywhere else, negative equity and continuing losses are a problem. For here, it's cash flow, revenue versus expenses each month. So, look, that's easy. How does your client assess? I think that's what we meant to say there is assess. It's a cash flow document. What's your payments? What's your budget going to be? If they can't produce positive results out of that budget, you're going to have a going concern. Why stress? They either give you the evidence or they don't.
They're not required to give you the evidence. That's the conversation we're not going to have right now.
Oh, no, in this level, they are, if you're not cash flowing.
You don't have a concern about their going concern. They're not required to give you.
Well, I'm just saying there's really, to me, no indicators of this. He's going to say he doesn't care about indicators. He wants to get it anyway. Okay. Well, I think what we're doing is we're hearing people push the rule that way. I don't necessarily agree that I read it that way. Okay? That's maybe a fair way to say that. So you get mixed definitions on when those indicators are important, when we would have to jump. But again, we're not really jumping. We're asking client to do something. So how does the client assess it? Look, it's easy. Where's the budget? Where's the cash flow? How are you budgeting this project out? If it doesn't pencil out and the numbers are red and you can't make it another year? Yes, sir. Oh, well, how do I assess for impairment? We're going to be back to the same conversation at the end of the day, aren't we, really? If I have to go back and try to assess fair value, we're going to basically cash flow that thing back to present value. I mean, there aren't too many tools available for us, are there? Really? It's way high. And the answer to that might be the best possible thing for them is to take the hit. You know, I did a lot of public company auditing, and what everybody recognized is when they're going to have a bad year, what do? We opened up the spigot, and everything in the kitchen sink we could think about reserving just flowed right to the end because we had already screwed up the earnings per share. Let's not do this again in 2 years. In this particular case, I think they may be leery to do that, but the best advice may be just to say, if you're way overvalued, and we're looking at cash flow models to present value it, you're going to be over, you just probably take the hit. That's my world, at least. I mean, who cares? Honestly, it's a cash flow game. We're not worried about whether you can sell actually, another thing is, what could you sell the building for? I mean, honestly, if the building's going to change hands, if you've already answered that question, you know the gap is there. We already know the answer. We just can't quite have the courage to pull the trigger.
They're not going to sell for 15, 16, 17.
Yeah.
Once you get to 10, you don't have to future tax credits to add back to that.
And so now we're sitting here. If it doesn't cash flow out and it does that, and if we can see impairment, you're going to have to measure impairment against what the net present value of the future cash flows are going to be. There's no other way for us to do that, is there? Really? Appraisals probably won't do it for me, but because appraisals, what is the appraiser going to do really? Compare against similar buildings and cash flow. It's going to all come back to cash flow. I don't know. Jeff, isn't cash king? That's what you just said, that cash is king. New compliance opinion and testing for 19. We tried to stop that at the end of yesterday. When they finished, I said, look, everybody go home. Just do one thing for me. Relax. All you got to determine for 18 is what's going to happen in 19. Issue the Yellow Book report. No AUP. Calculate what's going to happen next year in your portfolio and tell the client you're going to have a change in these projects or a change in these projects. Fix your budgets. That's all you got to do for auditors. Fix your budgets. The note agreement in general. Benny? Document contains the amount of required funded reserves on an RD property, and it changes from time to time. Isn't it an adjustment to that note agreement? There's a form for it. There's an actual form in the handbook. I can't remember what it is. I know it's in. Yeah, it comes off the budget. But it's where it comes from.
That's where it starts, but they raise them.
Yeah, they raise them every year.
Yeah, so it's going to be in your budget once you get past that.
There's a form for the budget now, though. There's a form for it. It's in the attachment somewhere. I can't tell you the attachment number, but when the new Chapter 4 comes out, just go search for it. It's right there. For HUD, it's a 9250, but for RD, it's in the budget. I can't remember the form number. Should 3560 be part of supplemental data as part of the audit? If you go back to the handbook, and they didn't hand it out yesterday, so I didn't hand it out here on purpose. But if you went to look at that, if you actually somehow asked me for it and I sent it to you, you would see that the Form 3567 and 10 are listed as supplemental data. Just like REAC, HUD. It is in the list. They didn't maybe bring it up yesterday, but it will be supplemental data along with their own 4 schedules. Look, they're not looking for these. The client could do it themselves, but they are anticipating most clients will not do it themselves, so they allowed budgeting for the compilation or process to prepare those from an auditor. They allowed in the budget for that in the rule. That's true. So that's a yes. They will budget for that, but they're not mandatorily looking for it. If you want to do it on your own client, knock yourself out. They just assume most will have CPAs helping them do that. No. No, no, no. You're going to stay in Mink. Okay? Don't I wish they would go? It would be so much better overall in the end. But it's just too many system back-end problems. Not a chance in Hades in the next 10 years. Why assess control risk at less than high? Because I have to. Why do I have to? I can't separate out control risk for the financial statements and control risk for a HUD job for compliance. Cash, in particular, HUD cares about that. HUD cares about debt. HUD cares about reserves. HUD cares about the mortgage and the escrows. All of it's HUD. I don't know how to get around that any other way. On any other audit, I could do it all day long, but in HUD or RD, the answer is you can't do it. They control all assets and all liabilities of the project. It's compliance. That's why. Furthermore, that means I had to test controls. Therefore, my assessment better show what I did. It's really impossible. If you think about it logically, it's an emotional decision. We're used to doing it. The form says to do it. But remember, the form is in 2 pieces, financial statement and compliance. PPC keeps separating it because small business approach here, bolt-on HUD. That's nice. But HUD attaches their importance to every line item in the financial statements. So therefore, I can't really see these 2 things separately. That's just the nature of the form has driven people into a state of what to say that? Problem. And it's not that hard anyway. Disclosure of a sale, I don't know. What's the gaps? What does the subsequent event stuff say? Well, I can't imagine why I wouldn't disclose it. Subsequent. But I don't know that I have to. I don't know.
Might not go through.
Oh, so she said contract yes, listing no.
Lists of property.
Yeah, they did say lists. Yeah, I don't know why I would get excited. I think that's a good point. Everything's for sale.
That's true.
Even this body might be for sale. I don't know. I just couldn't find a penny for it, right? Yeah, there are, if the change in ownership sale, are there any situations where a stub period would not be required? Yeah, true. There's no HUD, say they refi with conventional debt and there's no HAP contract. The last audit required is the last full year done.
No, I didn't read it that way.
Well, go ahead.
Is there any situation the stub period would not be required from the original borrower? No, I can't think of one. HUD wants that that audit, because if they sell, let's see, the change in ownership, sale, HUD wants the first part and the second part, and the system will put it together.
Well, but I'm just saying, under the Miller memo, if I sell the project and I get rid of the HUD mortgage in the middle and no continuing HAP contract or other requirements.
No. Okay. No. All right. No continuing reporting requirement. Okay.
From a regulatory agreement.
Then they're out.
They're out, right?
They're out. If there's no continuing whatever, then they're out.
Just to make it like this, if the HAP contract changes hands, it's always, stub period has to be met. Always. Okay, just assume that. It's 100% HAP contracts changing hands. If a mortgage changes hands and the owner assumes or gets new HUD mortgage, it's still 100%. The only way you're out of a stub period report is if you have a HUD sale, new owner comes in, conventional debt, HUD mortgage is paid off, stub period's gone. Go ahead.
Tack that stub period. If they sold in January, you could tack that stub period onto your 20.
Sure.
Now, that's what I didn't get to just yet, is what she's reminding me of, and that's a good thing to remind me of. If I did have a stub period audit, and it just came up, someone in the back had one, say he sold it is selling this month, okay? So that stub period, and it has a HAP contract. So what he's going to do, he had a 9/30 year end, and he's going to sell in December. So he's going to just request a deferral of the 9/30 requirement to submit at the sale date. And he will submit for 14 and a half months. He could do it up to 120 days of a period, not 121. His date actually fell into 120 days. You can defer that. So you don't do two audits. You just roll back or roll forward into a stub of up to 1 year plus 120 days. Okay? That EIN stuff, go back to the HUD Audit Guide Chapter 1. That was removed in 2013. Well, the EIN number isn't. Okay? That stayed the same. Our letterhead does not include the firm's EIN. I don't care if it's on your letterhead. Some people put a transmittal letter in listing the information with the EIN. EIN stays. They are required. What do we typically see? A back page with audit transmittal letter information, the name, the firm, the EIN, the address. It's just attached, beginning or front, end or beginning. Email me and I'll send you an example. It could be on, some people put it on the report. Some people have a form. It's anywhere in the package. If the data is there, it's going to be bought on the, it's in the disclosure checklist for the peer review. It's right there. Did they include the EIN, the partner name? I was thinking about, the license number, which went away. They didn't ask that. Yes, I have samples. Email me. A mortgage banking entity. Oh my gosh. Best way to verify audit income of a mortgage banking entity. Multifamily or single family? Yeah, I mean, I take the number of loans that we issued. I get the loan list of loan files that are generated for the year. I calculate some overall averages of origination fees, and I just start doing analytical review. And all I'm worried about is cutoff between pipeline at the beginning of the year, pipeline at the end of the year. It's pretty simple to actually do. Okay?
Wouldn't you want to test controls there if you pick up all the issues?
Well, yeah. If I'm going into the other side, I mean, I'm just saying. I guess what they're asking me is risk assessment on this. Right. Did they get all their origination income? But if you're going to go into the further conversation, we have a lot more challenges here to look for the controls. Well, it is now. MSRs, especially if I'm selling servicing released or servicing retained, or I'm doing Ginny and I'm keeping certain premiums, those things are going to make a big difference to my loan sale than if I'm selling everything away.
Right, and then you still have your compliance issues of separating escrow.
I got big. See, that's just kind of an easier question about analytical review in my mind.
Because I think it takes so much more than analytical
Oh, no, to me, I see risk assessment. That's all I'm saying. My risk assessment's that. Then we have to go test. So fees per loan. I hope we have loan accounting where we can start looking at the revenue per loan, because there's a lot of tweaking in the loan files. That's way beyond an easy conversation. Yes. That's an easy yes. Right, Peter? Audit guide says yes. RD's audit guide will say the same thing.
Yes.
Here's the difference between RD and HUD. RD will care. If they see that report language in there, we also issued other comments to the client, another letter. I mean, RD is going to just crawl all over that. Because what's their concern?
Hidden findings.
You didn't record them as findings, and they should have been.
Same thing as HUD. That's why HUD wanted to get a hold of it. Hiding the findings. Number 20, stub period.
Oh, that didn't work out too good, but I can tell you this.
Yeah.
The Miller memo.
It's not in the HUD audit guide, the other HUD document. It's the Miller memo, and that is, if you can read it.
Yeah, there's a link.
If you go to Fast Multifamily, their website, look on the right-hand side and look for something they call the Miller memo, and because it was authored by Beverly Miller, and it talks in there about how stub periods are treated, beginning or ending, and how they're treated, rolling them into the most adjacent full audit for a year.
Look, I know we're late, so if you guys want to take off, tulip is the word. I hate to keep everybody here longer. I'll tell you what I will do, though. Now, how the Q&As get done, right now, the video will come out. Kathy will post a video associated with each question. In this particular case, I don't think I'll sit at my desk and get videoed. We will just type answers in there.